For the eighth time in a row, the Federal Reserve raised interest rates. It is a 1/4 point increase, the smallest rate hike since March. The central bank is warning more rate hikes are likely necessary to cool inflation even more. Joining us now to better explain what all this means for us, Dr. Ann York. She's the program director and economics professor at Meredith College. Thank you for joining us tonight, Dr. York. Let's go ahead and start with today's interest rate hike. Lower than the previous 6 increases. Seems like a good sign. What do you think this is going to mean for families?
Hopefully this is the light at the end of the tunnel of interest rate increases. There are more to come, but inflation rates are trending down. We had 9% inflation rates over the summer. Now we're around 6%. So we're on the right track, and we hopefully will see interest rate increases continue to moderate and hopefully stop at some point.
Well, how much of what is happening in the U.S. economy when it comes to inflation is dependent on what we see in other parts of the world, Europe, China? Can we take any signals from what we see overseas?
We can, in particular from China, because they had that zero COVID policy for so long, and now they have relaxed it. It'll be interesting to see what happens due to that. One fact could be more inflationary. Their consumers are going to be spending more than they had been when they were locked down. And that increase in global demand for goods and services could have an inflationary impact. However, hopefully any supply chain bottlenecks that have been coming from China and Asia will moderate, since that is where we get a lot of our goods. And if the supply chain bottlenecks moderate, then that will help our inflation rate. And hopefully that will outweigh any effect from the Chinese consumers spending more money now.
You know, the Fed chair said today it doesn't seem like they are going to be cutting interest rates anytime soon, certainly in 2023. How many more interest rate hikes, though, do you think we can expect?
Well, not even the Fed knows how many more interest rate hikes that they will have. But the fact that they've gone from 75 basis points to 50 to now 25, hopefully they are feeling more confident about bringing down the inflation rate. And anytime there's going to be a meeting of the Fed this year, there probably will be an interest rate increase, but a lower increase than they did last year.
Let's talk about the job market, because obviously the Fed is watching the job market very, very closely when it comes to tracking inflation. So what kind of economic conditions do we need to see to be able to kind of even us out and get us to a point where inflation isn't so bad and they can stop doing all these big rate increases?
One problem we have had in our economy is that the labor force participation rate has not returned to where it was pre-COVID. There are a variety of reasons for that, but that means that our labor supply is lower than it has been. And if we can increase labor supply, that will have a moderating effect on wage increases and a moderating effect then on businesses needing to raise prices to try to find workers and attract workers. I'm not sure what it will take, because it seems like our economy has gone through a lot of damage from COVID, and many people have many reasons for why they are out of the labor market. So there won't be one solution to get everybody back into the labor market. But if we could increase the labor supply, that will have a big effect on easing inflation.
Such a balance, and so many factors go into this. Dr. Ann York with Meredith College, thanks so much for your time tonight.
All right, thank you.